Microsoft is one of the largest companies in the world when measured by market capitalization. At over $3.1 trillion, it's one of the most valuable companies on the planet. But what are the shares really worth? How much is a fair price to pay for Microsoft stock? That's the question I'm going to answer in this video by doing a discounted cash flow valuation model on Microsoft stock. I'll share with you precisely where I'm getting the numbers from, all the inputs used to make this calculation, so you can see for yourself all of the numbers that are going in, all of the estimates, all of the forecasts, and all of the real numbers that are not forecasts that are going into this model. So let's take a look at Microsoft.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so three of the inputs I'm going to need for my valuation model are its market cap at 3.134 trillion, its cash and equivalents balance at 21 billion, and the total long-term debt at 45 billion. I also need the total average diluted shares outstanding at 7.47 billion for Microsoft. I also need the company's beta, which stands at 0.9 according to Yahoo Finance. I'm also going to utilize the Wall Street analyst estimates for Microsoft's free cash flow over the next 4 to 5 years. Now, those analysts that are following Microsoft stock, they forecast that the company will deliver 67.6 billion in free cash flow in their fiscal year that ends June 30th, 2025. Those free cash flows are expected to increase to 84 billion in 2026, 107 billion in 2027, 127 billion in 2028, and 162 billion in 2029. So now that we have all the inputs we need, we can jump into my discounted cash flow valuation model for Microsoft stock. Let me draw your attention to the upper left-hand corner where the free cash flow came in at 74 billion for 2024, then went to 67 billion in 2025, and going on up to 127 billion for 2028. These are the numbers I utilized from the Wall Street analysts that are following Microsoft stock. These were the free cash flows that I pulled from this chart here, and this is from ticker.com. So 162 billion expected for 2029, and then from the year 2030 to 2034, I incorporated my own forecast for free cash flow. What I did here is I looked at the short run growth rate in free cash flow from Microsoft, which was 17%, and I forecast that growth rate slowing down by 50% to 8.5% for the next 5 years. Then in 2035, I forecast the company's free cash flow growth will settle down all the way to its long-term growth rate of just 5%, which is the growth rate I expect of the economies where Microsoft operates, the nominal growth rate, not the real growth rate. The real growth rate adjusts for inflation. My nominal growth rate forecast is not adjusting for inflation. So considering that these are cash flows expected in the future, we need to discount them because money in the future is worth less to us than money today. I think everyone would agree. So all of those free cash flows expected from Microsoft between 2024 and 2034, the present value of those, what they are worth today, is $917 billion. Then when we look at the year 2035 onward, we can do the terminal value calculation, which looks at the free cash flow 1 year ahead, divided by the weighted average cost of capital minus the growth rate. And the inputs I'm using, the weighted average cost of capital is 9.3%. And I arrived at that by using the capital asset pricing model to get a cost of equity of 10%, at a beta of 0.9 with a risk-free rate of 4.5%, a market risk premium of 6%. The company has 45 billion in debt and a 3.1 trillion market cap. So I gave them a target capital structure of 25% debt and 75% equity. That all brought together comes to the weighted average cost of capital of 9.3%. So that's where I get the value of operations of Microsoft's business at $3.368 trillion. To that total, I add the company's cash balance and subtract the debt, which brings me to a value of equity of 3.34 trillion, divided by the number of shares outstanding at 7.47 billion. I finally come to my end result, an intrinsic value per share for Microsoft stock at $447.71 compared to the current market price of $421.50. Now you might be thinking, oh, well, that means it's undervalued, right? Well, not so fast. You noticed how I used so many estimates and assumptions to come to this conclusion. Because of all of the uncertainty associated with those estimates and assumptions, nobody knows what's going to happen in the future. So the numbers I used may turn out to be too low, or the numbers I used may turn out to be too high. And so to protect against that variation in the actual results compared to my predicted results, I give myself a margin of safety typically between 5 to 10%, depending on the company, the size of the company, and various other factors. So in this case, we came to an answer of $447 a share, and the market price is $421. So it's only a $26 difference. That's less than 10% difference. So in this case, I would be more inclined to say that Microsoft stock is fairly valued rather than say that Microsoft stock is undervalued. You can argue it's right on the borderline between fairly valued and undervalued. Not enough of a margin of safety for me to feel comfortable giving it that undervalued designation according to my DCF model. Now, I did run a couple of more scenarios where I increased the beta from zero point 0.9 to 1.25 and to 1. And in each of those scenarios, the market price would be higher than the current intrinsic value using the current beta of 0.9. So what does this all mean? What does this mean for investors? Well, this calculation, according to my estimate, if I was ranking it, and I keep a ranking of all of my stocks that I'm covering and I give them a rating, buy, hold, or sell, or borderline here or there. I would give this a fairly valued rating. I would give this a rating that it's trading at roughly the price that it should be trading at, but it still means that investors can benefit from this stock. It still means that I still feel that even with these calculations, if you were to buy the stock today and hold it for 5 years, that the price will likely be higher 5 years from now than it is today. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.